Hi everyone, I hope everyone's well. I'm just going to share my screen so you can see this presentation here. Brilliant, hope everyone can see that. Great, so for the purposes today, we're just going to we're going to start with a very basic overview of an introduction to financial planning and what is very important to begin with. So just a bit of housekeeping, just to start with. Everything that you hear about in this presentation, this is not to be taken as financial planning. This is just simply for educational purposes. And if you want more financial planning, an in-depth review, as Rose has already said, you can book a meeting and we can really get stuck into the nitty-gritty. Brilliant. Right. So today we're going to try and cover off how to select the right investments and the right tax wrappers for you. And we'll sort of look at, a couple of scenarios and situations. We're really going to look as well at how to make a pension more tax efficient, because retirement planning is obviously a very, very important part of any financial plan. And then we're going to do a brief introduction into the underlying funds and risk. So what's a tax wrapper? A tax wrapper is basically a financial product that has special legislation set up by the UK government attached to it. So for instance, an ISA, which I'm sure everybody's all heard of, an ISA means that any individual can invest up to £20,000 per year. And when you come to withdraw money from this ISA, there is no capital gains tax to pay on it. A pension, a little bit more complicated. A pension is a savings device. It's basically a current account. You put money into it. You can't access it until you're 55 years old. You can put into it, it's capped at £40,000 per year, or 100% of your earnings. And the great thing is about a pension is that for all of the money that you put into a pension, all the contributions you make, the government will give you the tax back inside that pension, which obviously is more money, which is then invested and potentially can achieve more growth for your retirement. A general investment account, that's basically, it's a current account that's just invested, has some underlying stocks and shares or bonds, depending on what we've picked and chosen for you, but we'll cover that a bit later. Bonds. Now, bonds are a little bit more complicated and they sort of go beyond the scope of this presentation. If anybody would like to talk more about bonds, then again, by all means, please book a consultation. We can sit down and we can do a whole education piece on bonds. So now an example with pensions, just moving on from what I mentioned earlier about the government giving you the tax back. Let's say, for instance, you're paid £100 a month, right? Now, as a basic rate taxpayer, you would pay 20% tax on this £100. There's £20 that would go to the government, £80 would go in your pocket. Now, if you took this £80 and you put it inside your pension, the government would give you that £20 back and they would put that in your pension. So now, rather than having £80 invested, you've now got £100 invested. And we look at obviously investing these things for retirement, it's a retirement product, and therefore, it could be invested for 10, 20, maybe even 30 years. This is 30 years worth of growth. So, pensions are really, really powerful tools, not just from an investment point of view, but also from a tax saving point of view. So another scenario with a pension is, say, for instance, you're a higher rate taxpayer. So you're paying £40 to the government and you're keeping £60 at the end of the month. Now, if you put that £60 in your pension, the government, through your self-assessment, the government would put in £40. So now you've got £100 invested, which is fantastic. When you come to retire, you pay income tax on the money you take from your pension. So if you're a basic rate taxpayer at retirement, you are only paying £20 to the government rather than the £40 that you would pay today. So again, there's another scenario as to why pensions are extremely powerful tools when utilized correctly. You are also allowed to take 25% of your entire pension fund tax-free, which is fantastic if you want to make a large buy something large at retirement. And the other thing that the other piece of legislation attached to pensions is something called death benefits. What death benefits means is that your pensions can be left to beneficiaries. Now, depending on what age you are when you die, depending on whether or not you've accessed your pension, changes the rules ever so slightly. But as pensions are treated as being in a trust, therefore already outside your estate, if you were to die tomorrow, your pension fund may not be liable for inheritance tax, meaning that they are a tool for legacy planning. For instance, if you have a beneficiary that you want to leave some money to, pension is a great way to be able to do that. So if we move on, we open up the conversation of retirement planning. Now, retirement planning is we ask soft questions, right? Very open-ended questions, and they're questions that sometimes can be quite difficult, and they're questions that we often don't ask ourselves because we don't think about retirement. We don't think about what it's going to be like when we're 60, 70 years old. So a few questions that we've got here to think about is, what income do you think you're going to need in retirement? Is it going to be the same as it is now? Is it going to be more than it is now? Where do you see yourself? Are you still going to be living in the UK? Are you going to downsize? Are your children going to still be financially dependent? Another one that people don't think about is, what age are they going to retire? You see, you're allowed to take your pension at the age of 55. The state pension age for a lot of people won't kick in until they're 65, 66, 67, and that's still meant to move up over as the years go by. It's another large question that people don't ask themselves. A lot of people believe that they will just keep working forever. Some people like the sound of retiring early. Have you got enough money to do that? So one of the things that we do to answer that question, we'll do something called cash flow modeling. And that's where we take the money that you have now, or the money that you can afford to be able to put into a pension. We also take the money that you can afford to put into a pension over the next 10, 20, 30 years. And we'll put that into a report, and we'll analyze, and we'll show how much, if you put in X now or X tomorrow, you'll have when you come to retire. And that's a really powerful means of financial planning, because it means that we can essentially see how much you need today to be able to survive tomorrow. Again, it's something that we seldom think about, but it is so unbelievably important. And as I've already said, another big question is, do you want to leave a legacy? What is the value of your estate? Is the value to how much you want to leave your children? I've met some people who say, absolutely not. They can make their own money. I want to spend it myself. And that's no problem. And these are things that we'll look at. So if we move on to discussing what is an investment, because it's all fine that we have these tax wrappers, but where is the money actually going? What is it actually sitting in underneath? So I think to sort of frame that question and frame that concept, it's important for me just to give you a brief market update, because I know that a lot of people at the moment are probably a bit nervous about the idea of investing due to obviously the current situation we find ourselves in. And, everybody's going to have seen the news and seen that markets have been volatile. So right now things are cheap. And that is an important concept to remember, that actually when things are low down, that's the best time to invest. And that's obviously what we're looking to do with a lot of our clients at the moment is, they've called us up and said, hey, look, we've got some investments already. We'd actually like to put some more in because we know that there's some bargains to be had. You'll also have heard this word volatility, and that is basically markets sort of fluctuating. Now, volatility can be scary over the short run, but actually volatility can leave quite a lot of opportunities for fund managers to say, hey, look, I think something's undervalued, or I think something's going to go through the roof, or just as well, something's going to drop. And that leaves great opportunities to be able to get into the market and obviously see some potential growth on investments. So obviously we can discuss more in-depth concepts about what I believe the outlook is going to be over the short term, over the long term, because I'm sure there are some burning questions surrounding that, because obviously it is quite difficult to sort of tell what's going to happen at the moment with things like furlough schemes ending and second waves of infection coming. So I'm happy to sit down with anyone and obviously just puts people's minds at ease. Perhaps you already have investments that you would like reviewed. And this is what we're going to try and cover a little bit more now, is what we look at when we look to invest some money. So diversification, this is key. We look to, rather than investing your money into a single stock or a single country, we'll look to invest it over cash, property, emerging markets, and more developed countries such as the UK, America, Japan. We look to invest in tax efficient funds to make sure that you're not paying any more that you need to be paying, or at least the fund isn't paying any more than it needs to be paying. We make sure that our investments, they're forward looking, and that our fund managers are not looking at what's happening now. They're not just being reactive, but they're being proactive. So for instance, they are looking at what's going to happen in September. What is going to happen when the furlough schemes end? What is going to happen when we have the second wave of infections that we're already starting to see in places like Germany, which again is a country that is a solid economy that we would be looking to invest in. So it's important to be able to look ahead. Now, there's a lot of talk about active versus passive. This is, again, something that sort of goes beyond the scope of what we're talking about in this particular session, but it is something that I'm very happy to sit down and talk to anyone about. I'm sure there are people out there who perhaps already have a pension, and they'll see this word active or passive and they'll think, what is that? I need to know more about that. And that's absolutely fine. We can sit down and talk about that. And we also look at the fund manager's experience. How long has this person been working in their particular field? How good are they? What is their return? Because we need to be very diligent about where clients' money goes and how it's spread. And that brings us on to sort of how we do this. And we look at your risk. And this will bring up more soft questions, just like we spoke about with retirement planning, the things that people haven't thought about. So when we look at risk, we send a psychometric, and we do a psychometric test, a psychometric analysis of where you sit on the risk scale. There are a lot of people out there who might be young and have huge appetite for risk, and they'll say, I don't mind losing a little bit over the short term if it means I'm going to make a lot over the long term. We also like to sit down with perhaps older people who are already taking their pensions and they're nervous, they're worried. They say, look, is the underlying fund going to carry on being able to achieve what I need it to achieve? And these are really important questions, really important concepts that we would sit down with yourselves and analyze and pick apart and pull apart and see whether it's working for you, seeing whether it's efficient for you. So we also look at affordability. Now, there are thousands of different funds and thousands of different products, all of them with slightly different charging models or different charging structures. And obviously what we want to do is keep those costs in check, keep them low as possible, and while also providing the best product and the best service. So this is something that we'll also take a look at over the long run. We'll also look at your goals and your need to invest. If you are someone who already has a good pension pot, you might be taking too much risk. You might not need to take so much risk. You could scale it back. And then we also look at your capacity for loss. We look at your affordability. How much have you got coming in and how much have you got going out? This is also a big part of the financial planning process in general, is making sure that people, they're not overspending. They're not spending too much. And as I've already mentioned, we build this into the cash flow modeling. So we'll look at how well a fund is doing, not just over the short term, but also over the long term. And we'll change it and tweak it if need be. And again, I'm happy to sit down and talk about these concepts in more depth with people and perhaps go through some of the psychometric questioning, and you can get a feel for it. And just because your questionnaire says that you are of a medium risk, does not mean you have to go for that at all. We can take a wider view on that. We can look at what's important to you and the goals, again, that you are trying to achieve. So the future financial planning sessions, there are obviously, I've had a couple of questions come through and things like that, and I've looked at those and I've sort of tried to piece together essentially what's important to people. I think really, we're trying to look at efficient pension income in retirement. This is the major concern really for most. If you're, say, a younger person who, for instance, you're saving to buy a house, you're saving to buy a mortgage, we'd look at more, we'd look at going down the lines of things like ISAs and savings that you can withdraw today to be able to meet your goals for tomorrow. Retirement, is obviously something that's much further down the line. We also look at inheritance tax planning, because although a pension is outside of your estate, most things will still be inside your estate. So things like property, perhaps you have a family home, perhaps you have got some savings investments, even in some cases, parts of family businesses, they are all liable for inheritance tax. And the UK government, HMRC, they will come along and they will take their pound of flesh from people's estates. And this, obviously this is widely talked about, it's quite controversial, but it's something that we absolutely need to look at. And it's something that we can structure so that your estates are tax efficient, they're still invested, and they're also protected for your future generations, which is something we call bloodline planning. And we also look at establishing investment companies. These are, again, this sort of goes beyond the scope of what we're trying to cover now, which is sort of trying to cover the basics of your pensions, your investments, your day-to-day savings. But again, these are things that we look at. And we also look at protection strategies to make sure that in different scenarios, you are covered. So, I think really, without bombarding you all with too much information, I'm sure there's some burning questions out there. So, Rosie, do you want to go over the questions?
Excellent, thank you, Alex. If you just want to stop sharing your screen, and we can go through the questions. So, we've had some questions sent in, and there's a couple I think we can cover off reasonably quickly. So, Edward Shoesmith from SDS Plumbing has said, how much should be in his retirement pot, and how can he create that and manage it in a cost-effective and a tax-efficient way? So
a pension, you have something called a lifetime allowance, this is how much you are allowed ultimately to put into a pension over the course of your entire life. And this currently stands at just over £1 million. Now, you can only put up to, as I mentioned, 100% of your UK earnings, capped at £40,000 a year into your pension. Really, we would sit down and we would do a cash flow model, and we would say, how much do you think you're going to need in retirement? And then that's the figure that we would aim to achieve over the course of however long it may be. I'm not sure how old you are, maybe you're younger, a bit older, we would look at how much you would need to start putting in today to be able to achieve how much you would need tomorrow. So that's obviously something that we would sit down and really dig into, perhaps on a one-to-one basis. Okay.
And then Alex, on the tax efficient side of that, is that again something you would look at Edward with? There's lots of different options out there to make sure that it's all, you can help him with that.
Yeah, so depending on how you're employed, whether you're self-employed, whether you are employed, whether it's your own business, there are different ways that you can pay into a pension. All of the ways that are currently offered to individuals now, they all receive that tax back, that income tax kickback of the 20% up to that sort of 40,000 euros.
Alex, that leads us neatly actually on to the next question we have from Peter Lambert, who's asking, he's currently paying his pension contributions from his personal account, but he owns a company. Should they actually be going through his company?
Well, again, it depends on how your company's set up, but if you pay directly from your company, you can write this off against corporation tax, or if you're paying it out of your pocket, then you get the tax back when it goes into the fund anyway. So really, again, that's another one where we'd have to sit down and look at your personal tax situation and see how much you're actually paying in tax to be able to understand what's best for you. But again, two ways of doing the same thing, but it just depends on your personal situation.
Okay, excellent. And we had a couple of other questions from Marilyn Price and Mita Palaja, but they're more around the sort of property side. So again, Mita and Marilyn, if you're on the call now, I'll send you a link to book in with Alex, as we've got some really interesting cases he can go through there with you. And we've had a couple of questions come in during the call today. So we have Greg Solomon, I'll just read out his question. I've become a fan of passive tracker investments like Vanguard with ultra low costs. How have tracker funds fared during the volatile market drops this year? I don't know if that's something you can answer now, Alex, or whether that's something we could pick up with Greg afterwards.
Yeah, I mean, I can answer it now because I think it is important actually perhaps just to touch a little bit more on the active versus passive. And Greg, you're absolutely right. Passives are cheaper than actives. And without getting into the maths, most passive funds have done better than active funds over a very long period of time. So an active fund is where you have a fund manager who is checking a fund on a daily basis. They're looking at every single stock, every single share, every single bond, every single property value within that fund on a daily basis. And they're asking, is this still right for this fund? Is this still right for our type of clients? And obviously you pay a premium for that. Now, a passive fund, what it will do is it will copy a basket of shares based on perhaps the FTSE 100, right? So it will be full of shares of companies that you've all heard of, such as BP and GlaxoSmithKline, Rolls-Royce. And what it will do is it will simply track the market. It will track the growth, right? Now, although you still have a fund manager checking to make sure that all these different assets within the fund are doing what they say they're doing, it's slightly less hands-on, and therefore it achieves much lower costs. Now, to answer Greg's question, how have they done? Well, I actually, funnily enough, have got some of my own money in Vanguard's passive tracker. Vanguard was set up in 1979, I think, and it's one of the oldest, one of the best trackers out there. Tracker funds, they unfortunately will, as the markets track down, just as the name suggests, they will also track the markets down. Whereas an active fund, you have a fund manager who will say, well, it looks as though these shares are about to decline, they're about to devalue. So what we're going to do is we're going to change. We're going to swap what we're invested in to try and remove this drop in the market. Now, passives, although they do track the market down, the fund manager will jump on it and he will change what's going on.
How have they fared, Alex, during this volatile time? Has it been a disaster for them? Are they stable, or
they are just as volatile? It's difficult to say because obviously we haven't seen this sort of a pandemic like this before. They will track up as the economy recovers, right? So just on this point quickly for everyone, if you have got investments and you can see they're going down, if you take any piece of advice away from this, hold your investments. Do not remove money from your investments, because if you remove, you are guaranteed to have lost money. If you hold on and let the markets recover, then you should start to see things level out again.
Okay, well, Alex, that leads us into the next question very handily. What is the one top tip you would give people today? So is that it? If they do one thing, is hold their investments.
Hold their investments. That's my top.
Okay, perfect. And a couple of other questions. For people who already have their financial planning reasonably underway, how often should people be reviewing their financial planning structures and policies?
Well, we at Acuity will review your financial plan on a constant basis. Mm-hmm. And depending on the sort of level of service that you like, we will absolutely sit down with you once a year at the very minimum. Mm-hmm. You obviously have access, to all of our details, and you can call us whenever you like, and you can have impromptu meetings and ad hoc meetings. It's absolutely not a problem. You can opt for a twice yearly meeting. We're very happy to tailor a bespoke service around the client, depending on what. So
for people then, Alex, who don't have somebody managing, maybe they just have a pension from a couple of companies and they've taken out some ISAs, is your advice there that really this should be under constant review? It's not a tick box, I've done it, pop that in the cupboard. It's, they really need to be looking at this monthly, or certainly at least annually, as you said.
And they should especially be looking at it right now with obviously going on. Yeah.
Okay, brilliant. And last question I think we can finish on. We haven't got any other questions. Oh no, sorry, we have one question here from Ian Turpin, who's asked, I have an old company pension that I've converted into a SIPS, but also have a personal pension, which I'm paying into. Should he combine them? I think that's a wider question. People have different pensions from previous companies, previous roles. Is there benefits in combining into one there?
Yeah, so Ian, again, like this is one that, you know, we'd sit down with you and we'd look at the SIP and we'd look at the personal pension, because
do you have a summary of what SIP is?
A SIP is a self-invested personal pension. Essentially, it's a regular pension, and the main difference between a SIP and a personal pension is that a SIP has a wider access to more investment options, and you have the ability to be able to borrow from the SIP to be able to pay for SIP, to be able to borrow money from it for your company. But that again,
it's a form of pension.
Sorry?
Is it a form of pension, a SIP?
It's a pension, yeah. It's a self-invested personal pension. They can just do some weird and wonderful things in regards to lending. But again, that goes beyond the scope of what we're talking about. But Ian, in regards to whether you should be paying into both or whether you should combine them, really it's best to look down and look at what charges you currently paying and the performance of both of the pensions. So in some cases, yes, it might be an idea to combine them. In other cases, no.
Okay, excellent. And the last question, I think we'll finish up there. What's the worst mistake people can make with financial planning, Alex?
Well, not doing it.
Okay. Not getting started. Not getting started young enough.
Yeah. Not getting started young enough. I mean, really, you know, pensions are so key. You know, I think we all think we're going to live forever, and even if we do live forever, you know, you've got to pay for it. So it's really important to get this peace of mind in place, because you know you don't want to be relying on systems that you know at a later date that might not be working in an efficient manner.
Okay, so it's get started now if you haven't already, and get started early.
Yeah.
Okay, brilliant. Thank you, Alex. I think you made that really straightforward for everybody on the call, and we had some good questions covered off there. So you'll get the recording and the slides sent to you tomorrow. And after this call, I'll send out a link where you can book on via this meeting booking service, and you can schedule a time in Alex's diary. He's available from this afternoon, and then you can discuss your specific cases with him. It's a free consultation, so we hope you take that up. Well, thank you for joining, everybody. And we wish you a good rest of the week and enjoy the sunny weather. And we hope to welcome you back onto a webinar soon.